Good morning and welcome to the market update for March 13, 2020. Today marks another material day with a major change to our top level indicator, the equity action call, which has now moved to the red, indicating equities are at the mercy of policymakers at both central banks and elected officials. Let's dig in and take a look at where we sit today. The first chart I want to highlight is the equity action call. The EAC has moved to the red zone as of yesterday's close, indicating that we need to be holding cash or cash equivalents to protect from more equity downside. For many of you, you have questioned why the EAC has not moved into the red until as of yesterday's close, but if we look at the charts and the updates that we've done over the last few weeks, you will see that we've been in a range that has not moved entirely into the negative until after yesterday's close. Looking at our next level of indicators, the SIA chart's asset class rankings, we can see that there's been one change overnight. U.S. equities has moved from the 4th position down to the 5th position, and cash has moved from the 5th position up into the 4th. We're now sitting with a ranking of bonds on number 1, currency number 2, international equity number 3, cash in number 4, U.S. equity 5, Canadian equity 6, and commodity 7. Of surprise is international equity, which is sitting in the 3rd position, which is the first time that it's really ranked above U.S. equity in many years. U.S. equity in the 5th position, which has been dominating the asset class rankings since the latter part of 2011, is certainly a material surprise, and we'll get into more of that later. So what makes this EAC different than what we've seen in 2011 and 2016, where we saw SIA Wealth Management's indicator, the equity action call, move to the red zone? There's 3 major differences today that I think are material to what could make this bear market a little bit tougher than fighting off the 2011 and 2016 and make it look a little bit more like we saw in 2018. The first is that we had more political unrest before 2018. We had a largely unpopular Republican president leaving. The person that was replacing him was faced with dealing with some of the challenges that had been brought in a post-9/11 world, and there was an up-and-comer in Barack Obama with completely different ideas than would have been presented before. This was also mirrored in many countries around the world. The political ideology and the market infighting that we see today makes it very difficult for policymakers, both even at the central bank level, but more importantly at the elected official level, to get along and do something that's going to be material to make equity markets stop their downward trend, which is what they did in 2011 and 2016. We have big ideology differences between Trump and Merkel, and we certainly have a significant market correction happening in crude oil because of the differences between the Russians and the OPEC countries. The second level that is a bit different than what we saw in 2008 is the world is dramatically in debt. We've seen over the last few years that in 2010, 2011, 2014, 2018, when we saw the 30-year yield move up to the top end of its range, which has been in a downtrend since 1981, that the markets have reacted very violently. The debt that we saw in 2008 through the asset-backed problem has only grown into more consumer and business debt over the last 10, 11 years. The third area is certainly on everyone's mind these days, and started this whole crisis to begin with, is the coronavirus and COVID-19, which hangs as a major unknown because many countries were not as prepared as they may have been since this virus has propagated around the world. The United States has been highlighted as a country that did not have proper testing and did not have policies in place, and a lot of these policies are being questioned over being knee-jerk reactions to what is now happening as a rapid increase in the number of cases within the United States. So what are the risks of the red equity action call now coming through and not giving us what we want in the protection, where we get whipsawed and we see us move back to the green zone without any significant downside from here? There are major differences which I highlighted before, but if we are going to see correction back to the green zone, we're going to see policies implemented that are going to help the stock market move back. We're going to have the players such as Trump, Johnson, and MBS start working together with Merkel, Macron, and Putin. So the differences, political ideology, are going to have to be put aside for a period of time so policy makers can work together for solutions that will work in the common interest rather than, as for example, America first. And we're going to have to see the OPEC nations start to come to terms with Putin and make a situation that has over liquidity in the market and essentially a trade war come to a quick end. And finally, the coronavirus needs to be stifled a little bit quicker than markets are predicting. We've seen cases increasing in the Western Hemisphere a lot faster than what were expected, especially in the United States. But we're going to need coordinated government action as well as citizens buying into this action and isolating themselves more during this whole crisis, along with fiscal stimulus, which is going to keep businesses afloat during a time when consumers are not able to spend, even if they really want to. I don't see the odds of these actions coming in the near term. Certainly the political unrest between Trump and Merkel, for example, still remains, and we see Russia and OPEC even going to higher levels of war over crude prices as the Saudis are now trying to attack with low prices into the European market, which has largely been supplied by Russian crude to this moment in time. As far as coronavirus, it's anyone's bet. If you look at some of the forecasts that are coming out on that, there is a significant expectation that things are going to get a lot worse before they get better, and whether or not those policies, especially in the United States, are going to be in place to get it to crest and to reduce, as it did in China and some other countries, is yet to be seen. Let's take a look at our first chart, the SIA charts market equal weight index. It broke down severely as of yesterday's close, now moving below a consolidation pattern that has been in place since 2017. We've had some ups and downs during that consolidation, but we've now clearly broke that down as of yesterday's close into negative territory on that chart. We do have support, which is about 4 or 5% below where we're at, but more likely, given the oversold nature of the market and what we're seeing in the intraday even today, is that there is potential for a bounce in this chart. That being said, resistance will be quite severe around that $55,000, $56,000 level. So we should not expect it to easily get through that level. That is traditionally not what happens when we see an indicator such as this in such oversold territory. It may have a bounce, but it's usually short-lived. If we look at the SIA market equal weight index versus the SIA bond equal weight index, it tells the same story as what we saw with the market equal weight index. Bonds have been dominating, sitting in the number one position, and equities have now clearly broke down. So just like the previous chart, we were in a consolidation period up until the end of yesterday's close. We've now broken clearly below that. And now looking at the two circles that I've highlighted on the chart, those are the two other times that we've moved into the red zone. And fiscal and monetary intervention that was coordinated globally is what rescued us during those times. So we'll have to wait and see whether or not the fiscal and policymakers can come to terms with each other, but if they don't, the risks remain extremely high looking at this chart and the direction it's at. We could see a bounce, as we noted before. We do see equities as being grossly oversold on a near-term basis and bonds being overbought on a near-term basis. But again, it's going to, outside of a technical bounce, we don't really have a lot to go on that suggests higher levels. The next comparison chart I wanted to look at, I think, is important just from watching. Quite often when we see volatility like this, extreme changes in the market, we see different leadership come out the back end of it. And sometimes that can be seen even in the downturn. We're looking at the SIA International Equity Equal Weight Index versus the SIA U.S. Equity Equal Weight Index. And for the first time in a long time, we've seen a slight bit of hope that international equity might be outperforming U.S. equity. It certainly is on a near term, but we see the O that's circled down in the bottom corner there is the first time that we've seen a higher level of O's, so we didn't hit new lows on the relationship between international equity and U.S. equity for the first time since 2010. So this is quite material, at least on a we must watch this list. So when we see the indicators starting to get better, we want to watch that chart and see if we're moving above that 83.67 level, or if we've moved back into what we've seen previous to this downturn in that 64 level. So we'll be watching that chart closely, but it's good to have these things in the back of our mind as we communicate with our clients for what it looks like on the back end of this crisis. Looking at the chart for SIA International Equity, we can see, though, that it has broken down, and that's to be expected in a crisis like this. It has moved down through past two support levels with its close yesterday. It does have support, and reasonably strong support coming to it in that 26,564 level. And just like the other charts that we've seen, there is potential for a bounce up into that 28 to 29,000 level on a technical bounce, and it'll certainly take policymakers' activities to get us out beyond that, below a small and major change or bounce in the markets. The next chart is U.S. equity, which has been the dominant leader in the asset class rankings since the latter part of 2011. So it's had a tremendous run, and we can see that this chart has reached much higher highs than international equity before us, but it's also had a stronger downturn as of late, and especially over the last week or so has moved down below international equity. It's moved down below key support levels. Support is nearby here, so again, a technical bounce could be in place, but just like the previous charts, we would expect it's going to take strong policy by policymakers to make this go past its bear market status. Canadian equity is the weakest chart of the three equity charts that we're looking at today. We can see the drop in Canadian equity has been significantly greater. It's also the chart that has had the longest consolidation. It really has been range bound since 2010. For those who have been following SIA charts and SIA wealth for the last decade or so, you will note that commodities have ranked extremely low since 2010 in the bottom three asset classes, largely over that time frame until recently, where we saw gold move up strongly and we saw commodities move into the second position. It's all but given up back all those gains and now sits in the last position. Canadian equity has been weighted down by that commodity crisis. It's also been weighted down by certainly some political events and some disruptions to service across the country. Again, looking at it technically, we could see a bounce here. That 3.0 range is strong resistance for Canadian equity. Now that it's broken down below the meat of its consolidation, this chart has more potential to get weaker in the near term than any of the other two equity charts that we've seen. Crude oil obviously has been on everyone's mind since we saw the trade war erupt between the Saudis and Russians, as they had discourse over how to deal with the U.S. shale expansion, and U.S. now being a significant exporter of energy around the world. When we look at the chart, we can see that it did have a technical bounce. Again, that's not dissimilar to what I would expect to see on some of our equity charts that we presented today, but is now circled back into a column of O's. So that 31 level sits as key support. If we're going to have any expectation that this trade war is going to end or even have a slight reprieve, we would want to see a level of 34.91 reached to give us some indication that there's potential for some talks between these parties. A close below the 31 level opens up the door for our 2016 lows, again going back to when the OPEC nations flooded the market with crude, trying to stave off shale, trying to stave off expansion within the Canadian oil sands, and largely were successful in Canada but unsuccessful in the U.S. Those levels in the 28 range from there. Below there we see the low 24s, which would take us to times back in around 1998. So significant weakness in crude, grossly oversold as most of the charts have been here today. But again, there's nothing in this chart that indicates that near-term positive movement is likely outside of a technical bounce. The final chart I wanted to present is the U.S. dollar versus Canadian dollar. We can see with yesterday's close that we have broken above that 137.81 range. That's a significant resistance level. This opens the door for a potential test of that 146.29 resistance. That was the level we saw back in 2016 when we went into the red zone the previous time, and that has the opportunity of presenting itself over here. SIA has shortened its U.S. dollar, Canadian dollar rules. This is certainly a question that I've been asked quite a bit lately. In 2016, the Federal Reserve intervened. We are more sensitive in our indicators now on currency to test that, and you can contact us anytime if you have questions on it. With that, I'm going to end the update for today, and as always, myself, Jeremy Fehr, and our team here at SIA Wealth Management and our team at SIA Charts is available for questions. We know this is a very difficult time to explain to your clients what's going on. Hopefully, this update and the previous updates have been of assistance, and if you need more information, please contact us at your leisure. Thank you very much, and we'll talk to you soon.